Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app. People, it is Thursday. It is January 8th. That's Dan Nathan. G Swizzle here. By the way, the recently crowned winner of the Fast Money Anagram Challenge. Of course, in the middle, that's Elizabeth Thomas, she of SoFi. The important part, we'll get to her website, how you can reach it later on in the show, because apparently the /Liz is not ready yet, Dan.
Really, Liz? How is the do we need to get on the horn with
what did I just text?
Yeah, I mean, the holidays happened.
What did I just text you?
We had to, right. Guy said, do I need to call Anthony? Please don't call Anthony. The holidays happened. We had a little delay. We need to make sure it's all working properly. There's technology.
You mean a website working properly? It's not like it's 1998 here, Liz.
I don't know all the things.
World Wide Web working these days.
There's things that, by the way, we had been teasing a potential new entry, a guest today.
Yeah.
Oh.
The great Caleb Silver of Investopedia will be joining us at the bottom of the hour.
By the way,
just like saying,
you know what? There was a little FOMO, Liz, because we learned, the hard way, I guess, that you were a guest on Caleb's podcast a couple of weeks ago, the Investopedia Express. So we're like, you know what? We're like, we're going to bring him on ours.
Yeah.
You.
So this is my payback. You're getting back at me by having me on with him again.
Yeah. We're gonna do Liz's note that is not at SoFi.com/Liz. We can't wait until that happens, but it is at SoFi.com/on-the-money. So we got that. So you're gonna get your money right and all in one app.
Let's race through some things. So I was a little exercised yesterday on Fast Money. Elizabeth, I'm curious, and this has got nothing to do with politics, but at 2:00 yesterday, and Amanda can throw up a chart, whether it's Lockheed Martin, whether it's RTX Corp, whether, you name your defense stock, the president made some comments that were detrimental to the health of these stocks in terms of no more dividends, and you're paying execs too much, and you got to move faster. And these stocks all fell off a cliff. And then at 4:00 or thereabouts, he said, oh, by the way, we're raising defense spending by 50% from $1 trillion to $1.5 trillion. And they all went ballistic. So my point last night was, and again, I don't want to go down necessarily this road. My point last night was, if you're going to make those comments, bucket them all together. In other words, say, all right, this is the deal. We're going to raise defense spending by 50%. However, if you're a bad actor in the space, if you're paying, you're not going to participate in that. That at least the market could have been able to digest instead of having this wave lower and this renewed wave higher. With that said, I think you've been a fan of these names. These defense stocks continue to sort of rocket higher, Elizabeth.
Okay, so let's take the first part of the question first. And yes, I won't bury the lead. I do like defense. I like it more after the capture of Venezuela's president, but I do think defense has a decent opportunity this year. And generally speaking, I know this isn't about politics, but generally speaking, defense stocks during a Republican administration are expected to do better. Back to the beginning of the conversation, though, commentary that comes out of any administration, and I think we can all agree that Washington is not the greatest at communicating. So commentary that comes out of any administration that suggests there's going to be some sweeping change to some sort of law about the way that companies run their business, or the way that companies issue dividends or are able to put their stocks on the market, you can't take that as gospel. Because it has to go, first of all, you can't just say that and put it into action. It has to go through a lot of approvals. It's not reality in the moment. So reacting to it as if it's already happened is honestly just an opportunity for other investors. So I see that big dip as an opportunity for other investors that could have gotten in if, this big pullback, and then we sort of reverse it later.
Yeah, but I guess who's hold on in this environment, you're not it's happening within hours, right? And so you're not going to make any major decisions if you're a fund manager, that sort of thing,
right? So then to the next part of the thesis, though, if you're buying defense stocks, chances are you're probably not buying them because of the dividend. You buy dividend stock like Staples, you buy energy sometimes. You're not necessarily buying defense stocks because of the dividend. You're buying defense stocks because of the expectation of increased demand for those goods, the expectation of support from maybe a very big player like the government. So the statement later on about increasing defense spending is more of a long-term staying thesis for those names. And I think something that you can look at as, okay, maybe the playing field will change. But this sort of self-induced volatility that happens, it is frustrating. It is irritating for those of us that watch the markets, but it's going to continue going on. I just want investors to remember that there can be statements made out of anybody's mouth that don't actually have any chance of coming to fruition. So we're going to see those little blips in the market. I just don't think we can react to them or even give them that much airspace the next day.
Well, yeah, and we've gotten used to this though from the first administration and now obviously over the last year. Go to this ITA for a second, make it a 2-year chart if you don't mind, AD. The one thing I would say is that just go back to where this was trading in November of 2024. I mean, the assumption that defense spending is going to go up materially is kind of in the space. You know what I mean? Like, so that's another thing. Like, look at this move. I mean, so you'd think that we're in World War III right now based on the price action here. Well, Liz, this is a good time, I guess, to kind of think about your note or take a look at your note that you put out. What is going out tomorrow, I guess? Or
it came out today. Yeah, it's out today.
You can get that at SoFi.com. Where guys, SoFi.com, what?
/on-the-dash money, but soon, and soon was supposed to be in January, but soon it's just going to be SoFi.com/Liz.
Yeah. So that's an easy place to find, a research report there. But okay, Liz, you're talking about markets, geopolitics, that sort of thing. We can get rid of this now guys. Would love to see Liz again. Oh, there it is. So talk to us what you're thinking here. And this must have been something that was not on the tip of your tongue, you know what I mean, to be writing about this week, but obviously what went on over the weekend caused you to kind of dig a little deeper.
Yeah, well, I sent Mario an instant message on Sunday night and said, we have to write about energy or Venezuela or something about that this week. You just have to, because that's what's occurring and that's what's top of mind. So what we did though, as 2 days had already gone by and we saw what happened in markets and the news flow and everything, is we started with just geopolitical risk in general. And should markets even react to that? So the first chart that's in the note, if we can pull that up, is just a measure of geopolitical risk. Now, this goes back to the 80s. This is a very long-term chart. And you can see spikes there, obvious ones, right? 9/11, you've got the Iraq war, London bombings, all these different spikes. And then you see Venezuela on the end, barely even shows up as a spike. So as of now, this is a sort of a blip on this type of radar. The market, however, on Monday, as we all know, had a very positive reaction to this. There was a lot of excitement about the opportunity for U.S. oil, U.S. energy stocks. There was excitement about, okay, maybe if this gets resolved, we've got an economy that continues chugging along, and now we've got even more opportunity in our economy. Anyway, the geopolitical risk indicator says to us now, even though it felt like a really big story, not so big of a story at this point. That doesn't mean that it can't become one, but right now, in comparison, not that big of a deal. The more important takeaway is the next chart for investors, which is that you see all of these headlines when shocks like this occur, and you wonder to yourself, and this happened all weekend, you wonder to yourself, what is it going to look like when futures open at 6 o'clock on Sunday night? What are oil stocks going to do? What is oil prices going to do the next day? And funny enough, energy was not even in the top or bottom. It wasn't at an extreme in the market that day. And oil prices rose a little bit. Nothing really even reacted. But the takeaway here, if we look at this chart, this is deciles of geopolitical risk. Okay, so lowest geopolitical risk on the left-hand side, highest geopolitical risk on the right-hand side. And then this is how the S&P has performed 1 year after those different deciles. So main takeaway here, 1 year after the highest geopolitical risk, the S&P does the best, okay? And this is actually taking it further into cyclicals versus defensives. Cyclicals tend to do much better than defensives 1 year out from geopolitical risk. We wanted to show this because I think the initial reaction, the knee jerk is always, oh gosh, there's a war coming. Everything's going to get worse. This is all in upheaval. Uncertainty just got really high. And you want to sort of take risk off the table. You want to freak out and wonder, where should I not have exposure anymore? The reality is, as things cool down, or maybe as markets digest whatever that shock was, cyclicals tend to handily outperform defensives. And back to those defense stocks, you could put some of those into a cyclical category. So when we're looking at this actually jives well with an outlook that we have for 2026 and an outlook that many people have for 2026, is that the strength in the stock market will broaden out into other sectors, many of which are cyclical sectors.
All right. So I knew you had to say to yourself, I wonder if Swizzle's going to catch the kicking off 2026 turnaround bright eyes. Of course, that's a lyric from a song from Bonnie Tyler, Total Eclipse of the Heart, which you probably were a fan of at some point, like during your high school years, if I had to guess. Is that
I'm
correct?
Still a fan. What do you mean?
No,
not in the past tense.
A lot of people didn't know that. So don't think you're just going to sort of slide that past me, Elizabeth. Like you tried to sort of sneak a fastball past me and I rattled into left field. So well done by you and Mario.
Thank you.
With that said, let me ask a follow-up question. In terms of geopolitical risk, I don't know if we've seen the potential for one to turn into another one to turn into another one. Why I bring that up is, and I've said this much to the consternation of a lot of our Twitter followers, but to me, what we just saw over the weekend potentially opens the door for further hostilities in Eastern Europe, and then potentially something with China and Taiwan, which I don't think you can entirely take off the table. So the question is, I guess, is this potentially sort of the first of many geopolitical risks over the next few months?
Absolutely. And that's why I said at this point, it doesn't look like a big spike. This Venezuelan capture of the president doesn't look like a big spike. Now, there's been speculation and no necessary confirmation from the administration about what their real motives were, right? This was sort of veiled as a drug war situation, and that's what he's being charged with. But there's speculation that the motives were Venezuela is the only place that some of our adversaries all operate. And we're actually trying to increase leverage against China, increase leverage against Russia. And will this heat up the conflicts that those countries have already teased or are already a part of? Absolutely a possibility. And if that is the case, then we're going to see more spikes as time goes on. And the spikes will have different labels on them though, right? It may not even be about Venezuela anymore. Maybe Venezuela is just sort of the guise that the rest of this starts to heat up under. But we'll see more spikes if that's the case. And it could be a series of this over time. I don't know if it culminates into something any bigger, but this again goes back to, as an investor, we can't though sit around and invest just worried about when the next spike in geopolitical risk is going to be, because I think we can all agree that as long as this administration is in power, we will have spikes in geopolitical risk, right? And many of them may be coming from our side of the equation. We may be starting some of those spikes. So this is just sort of how the state of state is going to be, I think, during this administration. You can't invest trying to protect against it.
Yeah. The one thing I'll say about all this that surprises me the most, and I think that's maybe like some sort of sea change that's going on here normally, and Guy, you would probably say this if I didn't beat you to it. I mean, you'd see a rush to safe haven assets like U.S. Treasuries, right? Mm-hmm. You'd see, the dollar. But we're in a position now where, maybe if this continues to move the way that you guys just laid out, a permission structure for China, let's say, to blockade Taiwan. Well, we just did that to, a country that is very close, obviously, with China, or it gives a permission structure for regime change or increased, I guess, fervency for that by Russia in Ukraine. Well, you might see a whole host of different, whether it's trade wars and this and that or whatever, sanctions and all this sort of stuff, which may cause some of these countries to sell U.S. Treasuries, right? Like that sort of thing. So it could go the opposite way. We keep hearing about de-dollarization. Our friend Doug Cass was writing about this over the last week or so. So again, some of those relationships might continue to break down. I would say, why isn't Bitcoin trading better in this sort of environment? You would think that would be something. So again, all that stuff, it's going to be really hard to parse out. Liz, thank you for writing about it and helping us think about it. Guy, let's go back to some stuff that we were talking about yesterday and some of the volatility that we're seeing in in and around this AI trade. And, one thing I think is important to point out, we've been talking about how it started obviously with GPUs, then it went to the hyperscalers, right? Then it went to neo clouds, and then it went to server makers, and now it's gotten to, then it was energy, right? And there was a whole host of other things. We've seen this kind of rolling bull market. What we've seen of late in storage and memory is a totally different story. So let's go to SanDisk for a second.
That's the one today.
Yeah, and that's the one that's kind of captured at least our imagination when you think about this at $50, let's say in early September, and it got as high as $350. This is the same thing with Micron, by the way. It was like 50 to 350. Let's look at a 1 week chart. If you just want to see, we talked about that move on Monday. And then you saw a new high, and then you saw it reverse a little bit, new high today, then the sharp decline. Guy, if we were to see air come out of this space, and we're already seeing it, I just want to make a point of Dell, for instance. We highlighted that yesterday. That just broke down below this kind of support level. If you look at Oracle, which has had no bounce, okay, Oracle can't get out of its own way. So when you look at what's going on in Micron and Western Digital and Seagate and SanDisk, you might say it's different this time. There is no reason to believe that these stocks won't retrace the same way of some of these other kind of parts of the trade over the last year.
We had an analyst on Fast Money Tuesday night, I think, that was basically not trying to say it's different this time, but effectively that's exactly what
he actually did say. He's like, I don't want to say it, but then he said it.
Yeah,
so he did want to say it, I guess.
So look at just for SanDisk, and let's pull that up real quick because you don't see this all that often, but what we're seeing now, and Elizabeth can talk, in terms of technicals, you see things like this. This is a stock that trades 10 million shares a day-ish. Made a new all-time high today in SanDisk, basically 361. We're currently trading 315. You will notice that today's high is obviously higher than yesterday's high. I just said it's a new all-time high. And we're also below yesterday's low significantly now. So that engulfing pattern that you're seeing on what is probably very heavy volume is something you don't see. So to me, this is the beginning of something. I think the first stop is sort of the November high, which is about 285 or so. And then we'll see, if and when. But, to your point, this could be the beginning of an unravel of this trade that has made itself into now storage in a number of other sectors.
Yeah. And Liz, one of the things that's kind of stuck out to us is like NVIDIA, which, remains a good story. I mean, it seems like everything comes up roses for this company. Obviously, it has not, made a new high, and we've had the NASDAQ and the S&P make new highs. But it just seems like there's this kind of cooling off period that's gone on, which we've seen from time to time over the last few years. But when you start to lose the momentum, and Carter had a chart of the Mag 7 relative, and so did Doug, to the S&P 500, you've seen a breakdown of the momentum of these names. And when it goes into, like we just said, these groups that people were not paying attention to 5 months ago, and you see this sort of, appreciation, you kind of say, this is how manias end.
Yes. Okay. So I'm looking at all of the tech stocks that I follow, which is not the entire universe, but just the ones that I follow. Every single one is red today. And if you look at the increasing magnitude of the redness, right, I've got Micron as the most red on my list, and Micron being one of the best performers over the last year. So I think the takeaway here is that the fundamentals haven't changed in the last couple of weeks. The story about AI hasn't changed in the last couple of weeks. What's changed, and maybe not even the last couple of weeks, let's take it back to the last couple of months. What's changed is that investors started to realize, you know what? I've made a lot of money in these stocks. I'm looking at unrealized gains that are off the charts that I did not expect. I need to find other places now in a new year that might be able to generate returns, because I'm starting to lose hope that these can continue to generate that type of return. And I think that's healthy. I think that's good. And I think that's where a rotation is born. So what you're seeing is a lot of that rotationary appetite. The risk here is that if the pullback in these stocks, because as we know, the market always goes first, right? If the pullback in these stocks extends and lasts for a longer period of time where it hurts sentiment, and it starts to hurt sentiment enough that the companies pull back in spending, and you've got obviously just bruises across the board. If this occurs, you've got bruises across the board in the stock market. If spending starts to pull back, and then the story softens a little bit about AI and the optimism around AI, My stance about 2026 has been and remains that we need the AI story to remain intact in order to support the economy, in order to support market sentiment. But we don't necessarily need these stocks to produce double-digit returns, double-digit earnings growth in order for the economy to stay afloat. We just need them to not break down.
I'm going to take a little hard left here, but Dan mentioned something before about, if you had known what was going to happen over the weekend, Guy, what do you think would have happened in the bond market? And I would have said, you're going to see a rally in the bond market, flight to perceived quality. Rates are going to go significantly lower. Maybe we're approaching 4% in the 10-year, and we're not. What we're seeing is 10-year yields, stubbornly above 4.15. Japanese yields across a swath of durations are at all-time highs in terms of what they're seeing. I think the bond market is on slippery slope here, Elizabeth, and I know you watch this probably as closely as I do. Just thoughts on, listen, we haven't really moved all that much, but the fact that we haven't moved maybe in and of itself is problematic. So thoughts on the bond market?
Yeah, I mean, I think the bond market was in a dangerous situation back in December and maybe has been since the Fed started cutting rates again in September, when you saw the 10-year not go down like everybody wanted it to. And I continue to get questions about the housing market, which surprises me because people keep saying, well, and I heard this yesterday at a lunch. Well, the Fed will do their job, right, in lowering rates. The administration is trying to do their job by preventing big institutions from buying housing, and the Fed will do their job by lowering rates to help the housing market. I don't know how many times or how many different ways to say this. Mortgage rates follow the 10-year Treasury. They don't follow what the Fed is doing, and I think we've seen that over time. That's not going to budge things, and especially in a year where we're expecting the Fed to only cut maybe once or twice. So the bond market is telling us in the form of the 10-year that they're not comfortable. And frankly, it's saying that around the globe. So I think, yes, we're still seeing a little bit of a steepening yield curve, but I think the bond market will be the ultimate decision factor for a lot of things this year. And it will be the ultimate courtroom for whether or not monetary policy is working or is doing what it needs to do, and whether or not economic policy is doing what it needs to do.
Yeah, so the monetary policy, whether it's doing what it needs to do, is kind of interesting because when you think about, we're about to have this huge sea change, right? And the fact that CME Fed Funds Watch is only anticipating, let's say, 2, possibly 3 cuts in 2026. Is it paying attention? And I'm just going to say this rhetorically. Is it paying attention to what the signaling has been about the next Fed chair and what the president wants them to do, which I just think is pretty interesting. But again, there's going to be something that happens this year that causes the 10-year to either go meaningfully above this 4.2 level. And Guy, you think we could see 4.5 or 4.6, or that 3.6 level that we saw prior to the Fed starting to cut. Well, now we're at the end of 24, right? So again, that's going to be one that it's a sleeper right now, but I think that could be a surprise that we see volatility in 10-year yields. Guy, we've been talking about the lack of, I guess, bid for retail stocks other than Walmart and there's been dollar stores and that sort of thing. It's interesting today because we've also been talking about the underperformance of Costco, of Home Depot. So some of these big box ones, the Costco's really stuck out to us. I mean, I've been in the camp that I like the idea of a pairs trade. This is going back a month or so, is sell Walmart, buy Costco. I mean, it kept on going lower. Here you have this thing. It's up on sales, monthly sales. It hasn't been able to honestly get a 3-day move going to the upside like we have right here. You see that flattening 200-day or slightly turning down. What do you do with retail stocks?
Well, I mean, let's look at, since we have the chart up real quick, you can draw a downtrend from, the June high of about 1055 if you want to do that, Amanda, and you'll see that we're probably now through that downtrend line for the first time in a while. We're approaching the 200-day moving average, which we will probably flirt with and touch at least, and then we'll subsequently see if we take it out. What could potentially happen here, Dan, is relief rally to the 200-day that's flattening, maybe do a back and fill to the trend line. But, you might have put in a meaningful bottom here in Costco. So this break to me indicates that the stock for the first time in a while might be interesting. Now, in terms of retail specifically, again, we talk about this all the time, Elizabeth. It's not all stocks are not created equal. I continue to think Walmart is best in class. But finally, the dollar stores have picked up as well. And I know you talk about this, although you don't like individual names. I mean, TJX has just been a monster now for the last 7 or 8 years. So there are pockets of retail that absolutely will continue to work.
Yeah, the thing about retail is that you can have companies in the same category that are benefiting from consumer trends or consumers spending down, and a lot of the rotation that we saw out of higher end stuff and trading down by consumers. They can be in the same category but be mismanaged as companies, and they can have inventory problems as companies. So that's where you see a lot of the diversity in results in retail. Target versus Walmart was a good example of that for the last couple of years. Target had some inventory issues. Walmart didn't have as many inventory issues. So my point is, retail stocks are not all created equal. And when we say things as macro strategists, like the consumer is doing X, Y, or Z, it doesn't necessarily rising tide lifts all boats. That being said, the holiday spending season was very healthy. And I think that came as a surprise to many, given how stretched consumers have been from inflation and given how consumer sentiment had hit a real soft patch towards the end of the year. But holiday spending was positive. So I think that bodes well for retail results in the fourth quarter and perhaps even in the first quarter of 2026. So watch retail stocks for that. I think that in 2026, consumer staples probably has a better opportunity. I think there's probably going to be a lot of volatility in the discretionary sector because that's where consumers can change their mind quite a bit. We still haven't slayed this inflation dragon, and we've got stimulus coming, yes, but as we all know, stimulus is a one-time thing. It's not a lasting effect on consumer spending. So I think there could be some volatility in discretionary stocks, but staples, I think, have a good opportunity this year as stocks to do better, certainly, than they did in 2025.
Yeah, and if you look at the XLP, the ETF that tracks the staples, the problem, well, maybe it's not a problem depending upon how you're thinking about this. Walmart and Costco are the 20% or so, the top two weighted stocks in there. But then you do get your Procter and Gamble and some of these other names, so to me, that looks a little washed out. If you're just looking for an individual name, maybe it is Procter. That's a little bit washed out. So to me, I mean, Procter, let's pull that one up, Guy. I know what your eyes see.
We've talked about this many times.
Yeah, I mean, look at that. It's just, you can do a trend channel, do whatever the hell you want. I mean, a move back towards that 200-day could be the sort of thing that you could get. So to me, I find Procter and Gamble individual names right now in the space probably more interesting than the aggregation through like an XLP guy.
Yeah, and if Amanda wants to play this game from the March high in 2025, you can draw across those tops. You could see this downtrend, and it's going to wind up coming in probably not around the 200-day moving average, although the 200-day will come down. I mean, if you're looking for a level this can potentially trade up to, it's going to come into form. There's your channel. We're going to back away and get all that stuff off, and you can see where we could trade up to. And it's not going to line up exactly with the 200-day the bounce, although in time decay it may. So that's what I'm looking for in terms of a bounce in this name.
All right, Liz, let's talk banks for a second, because next week we're going to get, I guess most of the money centers, and I think Goldman and Morgan, and I think that, obviously these runs that we've seen in them in front of the earnings is a tough setup if you're looking as a trader. We have Karen Feinerman, our good friend on Fast Money, who's been long all these banks, and she agrees, as we've been talking about on the program, that doesn't like the setup. What she generally does as a long-term investor, she'll look to sell, let's say, calls against her long position in this sort of environment, and that makes some sense. You're not going to get a ton, right? If you sell a 1 month out of the money, 5%, you'd be lucky to get about 1%. You know what I mean? So it's not doing a lot, but you're moving your feet, as Guy likes to say, one way or another, a winner or loser, move your feet. This is going to be really fun on the Risk Reversal podcast. Tomorrow morning, Guy and I, we're going to introduce a new segment. It's called He Said, She Said, with our good friends, Kristen Kelly and Jennifer Sauerbach from the Wall Street Skinny. Have you seen their blog and their...
No, that sounds like fun, though.
You will love them.
I will play.
Wait a second. Did you get your hair trimmed?
Me?
A hard turn.
I did last week, but I haven't seen you.
Are you talking to me?
Yeah, you.
No, I didn't. I don't know. Somebody else in the comments said new hair. No, it's the same hair.
Great. Okay.
Great.
So
Dan always has great hair.
I know, but we're just doing this thing.
No, I know, but I was just wanting to make sure I got that in.
We're gonna debate from us as market participants, looking at bank stocks into the prints and a whole host of inputs that we use, and they're going to do it as former bankers and what they do, trying to demystify stuff. So that's going to drop on Monday. Now, just to be clear, and maybe in the comment section, I don't know if you were paying attention to this in our
group thing you can do.
In our group chat yesterday, Timmy and Amanda, and they were putting together some graphics and stuff for he said, she said. But one of them, and I can't remember who, it was either Amanda or Timmy, said they were referring to this segment as that's what she said. And I'm like, okay. So Liz, okay, Amanda said it was me. Sorry, Amanda. So Liz, what would you go with? He said, she said, or that's what she said. Now, the way we think about it, if it's the latter, they have to start the conversation.
Yeah, but there's a connotation to
what are you talking about?
She said.
There'll be so many great jokes forever.
Great jokes, but I think it eliminates the he part. I think you got to have, I think you do he said, she said.
Okay.
Yeah.
Well, and would you ever participate in that with us?
Absolutely. Yeah.
Okay.
Yeah.
Okay. That would be amazing. I mean, we get a lot of Liz. You get too much of us.
I know. These viewers are like, that's a lot.
All right.
Well,
so,
this is sort of he said, she said right now.
Let's do the banks really quickly because we definitely want to bring Caleb Silver, and he's got a lot of great stuff.
He's waiting patiently.
Oh, there he is.
Hi, Caleb. Wait, I have a question though. You talked about Karen Feinerman not liking the setup. Do you mean she doesn't like the setup because the banks have done so well?
The run up in a lot of these.
Okay, so she's protecting with options her long positions.
Yeah, what her expectation would be. Beat and raise and great commentary, you know what I mean? Like, that might be a sell the news. That I think that's like the interpretation.
Got it. Okay, so first of all, it's always very exciting when banks kick off earnings. I get excited about it that first morning where you're just like waiting for the big announcements, right? And I miss Wilf being the one who does that. But anyway,
we're gonna see Wilf. I'm gonna see Wilf next week.
Oh yeah,
yeah, in London.
Yeah, I mean it's an exciting. Oh, is he doing it? Is he doing the financials?
No, I'm just going.
Okay. Anyway, you got me excited for a second. Okay, so it's always exciting to hear from the banks in the beginning. I will say this. I was on Halftime Report with Stephanie Link yesterday, and she, like Karen, has been long banks for a long time. She talks about financials all the time. Her view was, yes, I recognize they're expensive right now as a group, right? They're expensive. They've had a good run. But she thinks that earnings are going to surprise to the upside this year. The results are going to be better than people even expect in financials. Now, that doesn't maybe include Q4 of 2025. So let's take that out of it for the moment. But in 2026, she expects the results to be better than expectations. So I just want to put that out there. The premise for that we had been talking about on the show, and I would agree with this, is that we're talking about big banks, though. We're talking about capital markets activity, M&A activity, the deals that could continue coming. Banks did really well last year without this deregulation. And then this year we've got deregulation coming. So maybe there is more of a tailwind for banks.
Have it coming. I mean, I keep hearing about deregulation.
I know.
I mean, I'm just saying, like, have we seen deregulate? That's what I'm saying. Like, will we be tested by some big potential merger? You know, I mean, like, I don't. This is some of the stuff, and this goes back to what we started, talking about, is like you get these narratives, right? We have the tailwind of these tax cuts, we have deregulation, all this sort of stuff. Well, what does that mean against like healthcare premiums for consumers going up dramatically, like all this sort of stuff. So again, I have a hard time, just like we don't invest off geopolitics, I have a hard time investing on policy that's meant to happen. Do you remember we had infrastructure week for 3.5 years? You know what I mean? From 2007. I mean that. So like, all right, just, no,
I hear you. And the CapEx spending that was supposed to be a benefit for a long time because of tax changes that were happening. Apparently that's all happening in 2026. The reaction may have already been pulled forward. I was going to say towards the end of that conversation, I'm actually more bullish on something like regional banks. I think you move down the cap spectrum and look at banks that are more sensitive to the consumer that are going to benefit more from a steepening yield curve. I think the yield curve continues to steepen. But from a consumer, if we're expecting lending activity to pick up, if we're expecting a cyclically healthy economy, I think regional banks can benefit too.
All right. Well, listen, we teased it. We also told you that we had a little FOMO because Liz, you were on the Investopedia Express podcast.
Watch this. We're going to do it.
We're going to clap him.
We're going to clap.
All right. This would be Caleb Silver. Caleb Silver.
Elizabeth, you can clap.
So Caleb for years has been coming on Fast Money, but he got a new title just recently, guy. Okay. So
read this because it's long. The title is
Put it
long.
on the screen.
My man.
You know what the next line there is?
Here he
Caleb,
is.
how are you?
He's going to get his own little box, I think. What are we doing? A 2-box? What are we doing, Bill? Yeah, I think we'll do
a 2-box there. Watch this.
Oh, 4-box.
Look at us.
Look at that. He's going to tighten up the shot a little bit so you don't see all our office in the back.
It's like it's Jobs Friday.
All right. I like the shot of Liz because we get a little SoFi action. Maybe next time Caleb comes on, we'll get a little Investopedia action in the back. So you are the chief business editor of People Inc. Okay, which is one of my favorite magazines, by the way.
That's a huge...
They like People Inc. so much they named the whole company after it, which is
a great
cool.
name.
It's a great name. I mean, and then you are also obviously the editor-in-chief of Investopedia. We have been doing Fast Money together for all these years. You have done our podcast. We've done your podcast.
Caleb knew Melissa Lee before we knew Melissa Lee.
Yeah,
that's right.
And you guys are very tight, which is amazing.
She's like my sister. I love Melissa Lee.
And you just did a podcast with Elizabeth.
Yeah, I have excellent taste, as you can see. We run in similar circles.
100%.
Yeah.
So
real knows real.
Yes, game acknowledges game or something, isn't that
game
right?
recognizes
Game
recognizes.
recognizes.
Oh dear.
Oh wait, do we have an IFP
for? I to bring my own.
Really?
IFP?
No, you'll play with us, and I'll tell you.
No, there's one there. It's got a bunch of earwax on it. You'll find one.
Oh, your earwax, by the way.
So Investopedia, you did this with Elizabeth, but the trends to watch in 2026. So let's put up the first slide and let's go through this, because a lot of things that I'm concerned about are things that you're talking about in terms of things watching going forward for the year.
Yeah, and we get this from our readers too, but I also get it from talking to smart people like you and talking to smart people like Liz. But obviously the weekend.
What do I look like, Swiss cheese over here? Come on.
You're just good looking.
Okay, thank you. I'll do that.
The weakening of the labor market, that's obvious. That's on everybody's mind, because that might ultimately determine the direction of interest rates, and plus the direction of growth in this country. If we're not spending, because the labor market's weakening, obviously things are going to fall apart very quickly. That said, we've been spending. Liz just alluded to it as well. Holidays were better than a lot of us thought they would be, but they're always better than we thought they would be, because we love spending in this country. The midterm election volatility, it's noisy. It's going to be super noisy. This is, 6-7 days into the year, and it's been pretty noisy already for 7 days of 2026. You're for the bull market. Are we getting tired here? I was just looking at the Schwab Stacks Movement Index to see what retail investors are doing outside of their defined contribution plans. I like to look at that because that's kind of not what we normally do. And that's been slowing a lot. You saw that slowing towards the end of the year, sort of slowing, especially given the dip buying we talked about a lot during the surveys that I brought on to Fast Money when I came on here. Individual investors were dip buying. They were very participatory until sort of the end of the year where they petered out. Been a good year, been a few good years. Is this year going to be as strong? Is their participation going to be there? I'm worried about this tokenization.
All right, break that down for a second, okay? Because, I'm one of these guys. I tend to be a little cynical. You've been around the markets long enough. I mean, we have a little PTSD from the Post.com, from the financial crisis, from some of this other stuff. If you're frustrated with kind of how we do monetary policy, as it relates to markets and all this sort of stuff. So I'm cynical. But then I look at something like this. We've been hearing about DeFi. We've been hearing about all this stuff for a long time. I think that you have, financial institutions what either are going to defend their moats or they're going to look to adopt this sort of stuff. And we don't know how it comes out the other end, right? So I know you take a hard look at this stuff. You listen to what your readers and, your listeners have to say. Just give us the 411 on tokenization and how might that make old guys like, Guy and myself think differently about how markets will work.
Okay. So let's take it back a little bit to tokenization and NFTs, right?
Okay.
Those were basically tokenized versions of real assets, not real artwork, but the tokenized version of it. They had an assigned value based on what the next fool thought they were worth, and fools at some point thought they were worth a lot, but they were just digital representations. Well, basically, we're going to get the tokenization of stocks, real assets, but stocks in particular, where it's not just the Amazon.com stock, the equity that actually is a piece of the company. It's a tokenized digital version of that has a representation and a value assigned to it, probably pretty close tracking to the actual stock, except it's going to trade on exchanges that are going to be open 24 hours a day, 6 days a week. So overnight, in the middle of the night, something weird goes on overseas or in overnight trading with some of these tokenized assets. What happens when, take a stock like Amazon, when the tokenized version of that gets blown out overnight for some reason or another? News, not news, real news, fake news, who knows what could happen? Stock opens the next day for trading in New York at 9:30 in the morning, even though it's always trading. the actual stock versus the tokenized stock. I'm worried about what's going to happen there from a price
like on ARB.
Some sort of arbitrage is created, and then people taking advantage of the ARB. There's going to be a dislocation without question.
Right.
I think you're 100% right.
Add that to the prediction markets, which is now you can just bet on the direction of anything at any point in time. Add that to tokenization of securitized assets like stocks. I think we're getting into some really weird territory.
And Liz, maybe you have a sense for this. Is like, is this a solution in search of a problem? Some folks will say, well, it's expensive and you have the lag of, the fees associated with trading stocks and T+1, clearing and this. Okay, but this, if you think that this is going to be innovative and you want to defend your moat because you have a 120-year history of doing these sorts of services, well, every year it gets a little cheaper, it gets a little smoother. So I'm sure we're going to get to what we don't need blockchain, right, for things to clear, immediately, that sort of thing. So I'm just curious how you think of that, because to me, I always take the over in some of this sort of stuff, like when it's actually going to have a meaningful impact.
So you're asking whether tokenization is going to have a meaningful impact?
Yeah, I mean, just in general, like what this might mean for market participants, you know what I mean? When you see this sort of stuff coming, because we're spending a lot of time now talking about prediction markets. And it's not like, I don't believe prediction markets are going to go the way of, let's say, NFTs, because they had a moment in 2020 and 2021, and then they were dead as a doornail, if you think by early 23.
Right. So my take would be that things, when they're new like this, they come out and the hype is really high and people think they're going to take over and they're going to change the playing field immediately. That never actually happens. They come out and the hype is high and people get excited about it and people do participate. But I think these things, especially tokenization, it's not going to take people out of the real market. I don't think it necessarily changes the real market. I do absolutely think that there's a risk of dislocation and just a difference between how, to Caleb's example, something like Amazon on the normal market versus Amazon as a token is trading. I think there definitely is a volatility risk there. But I think at first this is a subset of people, sort of early adopters, that start to actually do this. And it doesn't really change the entire playing field. But, we'll have to wait and see. I mean, the NFT thing, I remember artwork started to be NFTs. We were supposed to buy like rocks at some point. I don't even remember what that whole thing was, but it didn't make sense to me at the time. I understood that there were people that were really excited about it. And there were people that were early adopters and thinking that this was going to be the new way forward. But there were also people that thought crypto was going to completely eliminate stock exchanges altogether. And that hasn't happened either.
Caleb, top stocks to watch in 26. This is 5 names, and you could not have a more diverse list of names here. And each one of them have their own story. So we'll put them up and let's go through them. And maybe we can stop down with each one. But this fascinates me, this list.
Yeah, well, Oracle, obviously the poster child of the AI overspend. This is also the top stocks that our readers are most invested in. They're worried, as we've been talking about bubbles, about the fact that there may be bubbles, especially in the stocks that they own. But as you guys know, I've been showing this chart over and over for the last 4 years. This doesn't change. We keep buying the same stocks we're worried about because we're just conditioned to do that. And those are basically the stock market. So for those folks that are just contributing to their 401ks or their IRAs, they're just continuing to buy the same things, even though they're worried about it. We just don't change our behavior. As you guys were talking about earlier, the best performing stocks last year were not on this list for the most part, except for Robinhood.
So let's look. So let's look at these. So Oracle, the first one, obviously what happened from, I think it was September 10th was the day. I'm not exactly sure. The subsequent round trip and then the overshoot to the downside. So Oracle's number 1 on this list.
Yeah, and is it the poster child of the AI overspend, given the fact that it also tapped the debt markets? It was the first to really do that in a big way. That brought a lot of doubt, and it was a momentum stock for a long period of time.
All right, so I love the phraseology here, overspend. And one of the things I think is funny, and this is really important about this whole narrative, the money hasn't been spent yet. That's the point. The money has been basically say, we might pay you $300 billion over the next 5 years if you can build this out. And that's, Caleb, what you're just talking about. They had to tap the debt market, equity markets and the debt markets just to be able to say, okay, we might spend that to get that revenue. And that's a real problem for some of these companies. And it's also one of the reasons why, Oracle's CDS, right, insurance against their debt has shot up to, I think, all-time highs, or at least above where it was in the financial crisis. So to me, I think it's really funny to use some of this phraseology, but it's also one of the reasons why, and we talked about it on Fast Money last night, Caleb, is like Tim was being a little defensive. He thinks a lot's priced in here. I don't think enough is priced in here, because if they don't realize those contracts, by OpenAI, then you say to yourself, this company has actually really underperformed from a fundamental standpoint what their capabilities will be, throughout this build. And we know there was going to be a multi-trillion-dollar build. It's just whether the resources that are being allocated towards the build end up being fruitful.
Yeah. And I think that's the thing that everybody's worried about, right?
Yeah.
The math might not math here at the end of the
but,
day.
But to your point, poster child.
Poster child, right?
Okay,
Right.
yeah,
couldn't have picked a better one. It's
Yep.
not making necessarily the equipment like NVIDIA is.
Right.
There's actual product there, or Micron, like Liz was talking about earlier. Constellation, the AI power play. You could pick a bunch of different companies there. Plug Power, but Constellation being among the biggest, that was
100%.
supposed to benefit from building out the electricity capabilities and the capacity to power some of these AI data centers. Have we overshot here? And when it comes to that, of course, Robinhood to me was the perfect barometer of risk last year, right? And the year before, Robinhood got into more and more diverse markets as it's getting into the sports betting market, and as there was more and more enthusiasm, especially in the first 6 months in the year around crypto, given the promises from this administration. Robinhood was front and center and really enjoying a great rally there. Does that enthusiasm continue into this year?
And let's take a look at the next one, Berkshire Hathaway. Now, let me just opine quickly, and then you can sort of speak to this. Buffett premium value, that's sort of the question mark. But for me, and Elizabeth can opine quickly, to me, this is an inverse play of the market. If you think the market's going lower, Caleb, if I do, I think Berkshire Hathaway is going to outperform. And why is that? Because they have close to $400 billion now of cash sitting on their balance sheet, which is 40% of their market cap. So, Liz, you look at Berkshire Hathaway, which has clearly been an underperformer. Most people say it's because Warren's stepping down. I say it's probably because the market is penalizing them for having that much cash.
I agree that it's because of the cash. The Warren stepping down has been well telegraphed for a very long time, and Berkshire did just fine, even while that was being telegraphed. So I think this is about the cash. I think it's about the fact that they then were perceived as not taking part or missing this whole AI rally and missing a lot of the rally that had happened in 2025 and 2024. But as we know, when we find out about what Berkshire bought, we don't find out until it's already been 3 or 4 months after they bought it. So they could be doing stuff right now that's going to look genius in June when we all find out that they did it. So I do think that there's a good chance that Berkshire does well this year, just based on those the things that they could buy. And there's always this other part of just the psychology of a new CEO coming in. He wants to probably do some stuff of his own. He's going to want to put his mark on it. So I'm sure he has ideas, and they might be really good ideas. He's going to get scrutinized for it, and Warren Buffett are the impossible shoes to fill. But I think that Warren leaving is, I don't want to say it's not news, but it's just been so well known by the market. I don't think that's what's affecting the stock.
Yeah. So interesting. We've been in the markets obviously for a long time. And as traders or active market participants, there's always that game that Liz just kind of laid out, is like, what is the sort of company or sector that, that Warren wanted to get involved in? What are sort of crisis names that he might lend him, might be interested in? And we obviously have a little history. So now he's gone. Well, a lot of us, I'm sure there's people very close to the company who have a good sense of what are the things that kind of interest the new CEO. But Caleb, this could be really interesting. Maybe this is something for like your surveys, or maybe it's how you guys, I'm sure you're spending a lot of time thinking about prediction markets. I'll bet you on calcium poly market, there are some, bets being placed. What is the next thing? Yep. So normally, some folks may buy calls in Procter & Gamble because they thought Warren Buffett's going to do, that sort of thing. I'm just curious, are you guys incorporating some of that data into some of your surveys?
Absolutely. And Warren Buffett is one of the top sort of people that our readers are most fascinated with. Some of that is age, right? When you think about the people, and we ask people on our surveys, what are your top stocks you own and what stocks would you buy today and hold for the next 10 years? You're always going to see Berkshire Hathaway in there, because that's the older investor cohort that may have been in Berkshire A shares or B shares for a long time. They've made a lot of money and they're loyal to Buffett. So there's part of that, but there's also, think about what just happened in the last week here or so with Chevron, right? The opening up potentially of South American oil and the U.S. moving right on in there. What does Berkshire Hathaway own? Occidental Petroleum, big owner in Chevron, of course, big owner in natural resources in general, and getting bigger in that space. So maybe the timing was actually perfect, and maybe this will be the win in the sales for Greg Abel, who's very capable, by the way. And
very able.
It's not like Buffett's going to go play bridge all day long. He's the executive chairman. He'll be on every important call that they make as long as he's able to do it. So I think there's the age loyalty cohort of people who are just like Warren Buffett and no one else. And then I think it's the fact that this company may just actually be well positioned for this new energy transformation that got accelerated with the invasion of Venezuela last week.
Last name on this list is Strategy, MSTR. And, you know, we've talked about this a lot, Caleb, but I think it's absolutely worth watching in 26. I've said this for a while. I don't know if you agree or not, but I think the market is going to challenge Strategy's average price of their holdings, which is about $76,000 a coin. Yes, we've bounced a Bitcoin. We've gotten a bit of a reprieve, but just look at this chart and you'll see the stock really hasn't bounced all that much. So I think having Strategy on this list makes a lot of sense too.
Again, proxy for risk in so many ways, but also the extreme side of cryptocurrency risk. When you just transform your company to become a Bitcoin treasury, you're taking a pretty bold move there, and you're taking a huge bet on price. Now, if Michael Saylor was sitting here right now, he'd be laughing at us and saying, you guys just don't understand how this game works.
He's done that before.
You wait, and sometimes he's been right, and he could be right again. I wouldn't doubt it. That said, this, for a lot of investors, was maybe I don't want to own the coin, but I think this guy's a visionary. I want to own this company because he's going to own the coin. This was a proxy way of owning it that was actually seemed better than owning the ETFs or the spot Bitcoin ETFs that track Bitcoin. Actually turned out to be not the case at all. Our buddy Josh Brown has pointed this out a couple of times. Being a treasury is not a good business when you have volatility in the assets.
It's a horrible business. I mean, like, you think about this is like when it was trading, and I know we talked about it, let's say a year ago, Caleb, like when it was trading at a premium to all its holdings, and you think about all they had to sell almost everything at MicroStrategy that wasn't bolted down to the floor just to be able to continue to buy this. And the fact that it has no bounce, and it didn't bounce even when, you know, Bitcoin went from 87,500, I want to say 2 weeks ago, it was trading at 93,000 yesterday. So to me, I think an unwind that we will not know what risk assets are moving around because of this treasury company, that treasury company. Pull up BMNR. That's Tom Lee's BitMiner, and Tom is obviously a genius guy, and he's does amazing things in the markets and macro and this and that, whatever. And so he's I think the chairman of this company that buys Ethereum, and they talk about having use cases for, but that thing can't get out of its own way. So at some point, when you see wholesale selling of these things, it'll be interesting to see what the underlyings do, because again, if this thing starts selling off and then the Ethereum starts selling up and then they have to sell Ethereum, right? That thing's a bit of a disaster. And, you know, I don't mean this one in particular. I don't mean it's a reflection on Tom and his market capabilities in that.
No, but it shows you appetite, risk appetite by retail investors for companies like this that seem like they had a good strategy, pun intended, at the time. And when the underlying falls and it doesn't recover, that just shows you what kind of business this is.
2 in 3 readers believe AI-related stocks are in a bubble, which surprises me that the number is 67%, because the way the market trades doesn't appear that anybody believes that. So let's walk through this.
Yeah, we may fear the bubble, but it doesn't mean we're not buying into it. And you know, I think a lot of people, just because there's a lot of smart commentary out there saying, yeah, there's been spending bubbles like this in the past, and they go through telecom, and they go through the internet, and they go through the railroad, and they go through basically every industrial revolution. There is more money being promised here and pledged here, and actual real money being spent, but more importantly, real profits being generated. So Liz and I were talking about this on my podcast this week. There's real profit growth with these companies, and I think that's what the big bet is. That said, you can't be blind to the fact that some of these stocks have appreciated so greatly over the past few years, and nobody could have predicted that. So people are naturally fearful. That doesn't mean we stop doing what we're doing. Cryptocurrency always on the bubble list with our readers as well. And mega cap tech, you could put that and AI related stocks together. Basically, they're the same thing.
All right, Liz, give it to us, because again, I mean, we had this FOMO. That's why Caleb's here right now. I mean, you were on his pod, the Express here. I mean, what do you think of this? Because again, this is kind of a boring conversation. It was one of those ones over the last 10 years. How many times you're going to have to talk to your family over Thanksgiving about cryptocurrency, explain it to them, why it's going up. Well, this has kind of taken over that conversation over the last few years. Where is your head there? Because you also have a cohort of your members at SoFi who have been very involved in this trade, and I'm sure it's somewhat concentrated too.
Yep. So actually, we have an ETF. It's called the SoFi Social 50. It tracks the 50 most widely held stocks on our platform, and we always talk about the top 10. Fun fact, Berkshire Hathaway is consistently in the top 10. So I also would add to that there is a younger cohort of investors that has appetite for Berkshire Hathaway. So even with Warren leaving, as of right now, the last report that I have, it's number 9 out of 10. As far as the bubble goes, in my outlook, I've said this on the show, there is a section that we call Befriend the Bubble. So I'm not saying whether or not we can classify it as that. We're going to just continue talking about this as a bubble. And I think in 2026, your best bet is to just get on board with it, because yes, it's gotten a little bit inflated. Yes, things are looking a bit unhinged, especially in certain areas when you look at margin debt, right? There are definitely concerning signs, but is it at a point right now where it's so extended that it's so obvious that it needs to burst? I don't think so. So I still think that there is a good amount of runway in the theme and in the optimism that can be produced if productivity gains continue. And anecdotally, we've seen productivity gains. If we continue to see earnings growth and if we continue to see CapEx spending digested by investors, then I think that there's still room here. And look, you could say things are irrational. They can get a lot more irrational. I don't think we're quite in crazy town yet.
Doesn't appear that way. We mentioned where we can get Elizabeth's work, Caleb. If people have been living in a cave for the last decade and they don't know where to find you, where do they find your work?
Yeah, come to my cave at Investopedia or at Caleb Silver across all platforms, and the Investopedia Express live every Monday on all social platforms and then on demand. If you tune in this week, you will hear more smarts from Liz Thomas of SoFi, one of my favorite guests and people in this industry. So good to be on this show with you, Liz, and of course with you guys. Thanks for including me.
No, it's great. We love having you on Fast Money. I'm glad you stopped by here. I saw what you and Liz did. I thought it was fantastic. We'll do this again. Elizabeth Thomas of SoFi, Caleb Silver of Investopedia, but now a much bigger role. This People Inc. thing is huge. Congratulations, Dan, Nathan, Guy Adami. We're talking with the Wall Street skinny ladies tomorrow. That'll be fun.
That'll be on Monday. You and I are sitting down this afternoon with Mike Wilson of Morgan Stanley. He does his quarterly with us. That's going to drop tomorrow morning in the Risk Reversal podcast store or on the feed that's in the store. Rate it, review it, share it with friends. That's how people find it, right, Caleb? And then I'm sitting down later this afternoon with Andrew Ross Sorkin. You see that book?
ARS.
Right over there, 1929. A great book. I read it last month. And so that's going to drop next Friday. So we got a lot of great stuff here, people. So tune in, share it, rate it, review it, Guy. And what do you should you do that follow button?
Slam the shit out of the like button. By the way, in case you were wondering, Amanda is doing great. We'll see you guys later.
All right, thanks.